Good morning, ladies and gentlemen, and thank you for the opportunity to have a chat with you this morning about sovereign wealth funds. I suppose if we were to have this chat 12 months ago, it would be a very different chat and a very different discussion. 12 months ago, with the, the commencement of the collapse of the financial system, the credit markets, the sovereign wealth funds and other large bodies of capital were very prominent in saving many of our institutions. As of mid-07 through to, mid-08, the amount of investment that the sovereign wealth funds put into one industry in particular, the financial industry, was extraordinary. And that raised a huge discussion as to their motives, whether we're happy with that, what the future of it is. However, we're here today. Things have changed slightly, if not dramatically, in the last 6 months, as Martin and James have gone through. So let me see if I can grab this. Right, I want to spend about 20 minutes today, ladies and gentlemen, just going through a few basics on sovereign wealth funds. As Martin said, the McKinsey Global Institute has put out a very large piece, it's about 200 pages long, on not just sovereign wealth funds, but on, if you like, the power brokers that are coming out, private equity, hedge funds, oil funds, and sovereign wealth funds. But three things I'd like to go through today. What are we dealing with? Who are they? How do we define them? How do we recognise them? How large are the sovereign wealth funds and where are they investing their money? And the general view on sovereign wealth funds, has it changed and what are we looking at? And as I said at the outset, I think it's a changing view as we go through. Sorry, let me just get this right. There we go. Definitions exist, and there are a lot of them, and I'm going to just stick with two for the purpose of today, and we'll get on to exactly how that looks in terms of the landscape. The two I'd like to pick out of these 6 or 7 is the US Treasury's view and Standard Chartered's view. The US Treasury defines sovereign wealth fund for their purposes as a government investment vehicle which is funded by foreign exchange assets, which manages these assets separately from official reserves, reserve management funds and stabilisation funds. Standard Chartered defines it as ownership by a sovereign nation state rather than a regional or local state entity, not national pension funds, not central banks. And again, they get into reserve management funds, government holding companies, stabilisation funds, and the like. Let's see if we can get this right. Right. Here we have 7, if you like, definitions of sovereign wealth funds, and we're going to stage on the top 3 for the purposes of today. We have reserve funds, stabilisation funds, and government holding corporations. Reserve funds manage state reserves that are above and beyond that retained by the central bank. Examples of reserve funds could be ADIA, the Kuwait Investment Authority, and the China Investment Corp. Stabilisation funds are quite specific. They are usually out of the Middle East and Russia, and they are aimed at stabilising the flow of commodity and petroleum capital. A section of the sovereign wealth funds that most people are familiar with is the government holding corporations. And examples of that would be Temasek, Khazanah in Asia. And they act as a shareholder, provide oversight of the state's assets and state-owned enterprises, and they are very active. And these 3 we're going to concentrate on today. Others that could also be covered by that definition or other definitions include central banks and monetary authorities, state pension funds like our future fund, ministry, government and department agencies like MOF in Japan, and one that's very relevant to today that the Americans actually set out and created many, many years ago, things like the Resolution Trust Corp, looking at distressed asset management. Very quickly, what are we going to define it as? Look, why don't we define it as assets under management owned by a state, however legally structured in a separate vehicle. Therefore, as we said, reserve management funds, stabilisation funds, and government holding companies. How much money are we talking about here, and how prevalent are these sovereign wealth funds? As of the end of 06-07, and it's probably grown significantly since then, sovereign wealth funds had approximately $3.5 to $4 trillion under management. They were roughly 2 to 3 times the size of the hedge fund industry, 3 to 4 times the size of the private equity industry. although as you can see on the left-hand side of the page, quite a lot smaller than the insurance, mutual and pension funds under management. The difference is, however, that the sovereign funds, as we'll see in a few slides, are very actively managed, and they're getting quite clever in what they're doing and quite creative in how they're going about it. So in 2007, 2008, we're looking at 3.5 to 4 trillion of assets. We at McKinsey believe that within 4 or 5 years that will grow to probably 5.5, 6 trillion, IMF 10 trillion. Either way, a 12 to 25% rise in the next 5 years on the back of a 19% rise in the years 2000 to 2006. So what you're seeing is a lot of money concentrated into certain funds and certain controls, very actively managed and growing very rapidly historically and in the future. How's this come about? On the next couple of pages we're going to spend just going through how this has arrived. And most commentators, and in fact we all agree on this, it has come about through a growing trend of capital inflow for emerging economies. As of '98, which was only 10 years ago, there was basically a net balance of capital flowing into the emerging economies. As of last year, about 12 months ago, there was over $500 billion going into the emerging economies based on petroleum, commodity cycles and trade balances. I find this an interesting page, and we in Australia are not on this page, but we should be, because we're also running a trade balance that needs funding from offshore capital. If you look on the left-hand side of the page here, you'll see the Western economies with the States, the UK and parts of Europe, interestingly not Germany, all running large trade deficits, all needing funding. And if you look on the right-hand side of the page, you'll see the influence of, if you like, petrol and fuel imports and exports and the need for funding of that. And again, the Western economies are great needs of energy, and the developing nations and the oil-producing nations running great surpluses, leading to the changes of capital and the flows. One thing that is changing and has changed rapidly over the last 4 or 5 years, and we'll get on this next 2 or 3 pages, is just how the sovereign wealth funds are investing their money. Going back, I guess, to 2003 and before, the majority of the funds invested were through third-party intermediaries, funds under management, and they were, if you like, letting the managers manage their own funds and not getting involved directly. That's changed dramatically over the last 2 or 3 years. As of 2002, only around billion dollars of money was invested directly. The rest was invested in third-party funds. As of last year, it was 71 billion and 74 transactions. And this year, I'd suggest it's about the same. So what you're seeing is a move from passive investment from sovereign wealth funds to aggressive direct investment. This is a page I like because this explains a lot. On the left-hand side, we have the forms of investment that the sovereign wealth funds are undertaking. And we're looking at everything from direct investments, investments in public companies, but on a minority basis, pre-IPO minority stakes, and financial partnerships. This does not take into account the money that's managed by third-party asset managers. So what we're seeing is on direct investments, sovereign wealth funds investing directly in just buying large control of BAA, Sainsbury's, Madame Tussauds, quite a few football clubs. What we're seeing in terms of public minority stakes, which is where most of the action's going in the financial world, is seeing entities like Temasek investing in Merrill, Citi taking out in the same way, and Sony also. So we're seeing the sovereign wealth funds getting aggressive, willing to take minority stakes in public companies, having little control on it, seen as a long-term investment. We're seeing more risk. We're seeing, if you like, the sovereign wealth funds willing to go into assets and companies that are pre-IPO. In other words, there's a limited market. There's no public ownership. They rely on the public markets to provide that. And we're seeing more creativity. We're seeing sovereign wealth funds willing to get into bed with other sovereign wealth funds, PE players, corporates, all to make money and to make deals. The point of this slide, is that they are becoming creative. And they are now becoming creative in a very broad spectrum. This is the money page, so to speak, and this goes into a little bit of detail about how the sovereign wealth funds invested in some of the big blue chip financial institutions over the last 12 to 18 months. And there was a time late last year, early this year, when the largest bank globally in the world, Citi, the largest broker in the world, Merrill's, the largest Swiss bank, UBS, plus a plethora of other banks, were perilously close to going bankrupt. And if not going bankrupt, going very close to needing huge bailouts. And as time continued on for the next 6 to 12 months, that in fact became the case. And it's ended up with the governments really through their own investment directly into these organisations controlling them. But you've seen the sovereign wealth funds put over $20 billion US into Citibank. That, by the way, is now worth about $4 or $5 billion. So this is the crux of what I'm going to get to in a few pages, is that they've put a lot of money in, but they've lost a fortune as well. Over $10 billion into Merrill. Of course, Merrill's now owned by B of A. UBS lost and wrote off $49 billion US and had to be recapitalised by the Swiss government, and the sovereign wealth funds are putting in over $10 billion there. And I would suggest the $10 billion they've invested is now worth about $3 billion. So what you've seen is two phenomena. One is a huge level of investment, and a lot of it, by the way, is on what they call convertibles. In other words, they're getting a yield and a coupon, and they're getting conversion terms, and the conversions have to be very high to make money. Okay? For example, on Citibank, the majority of the money that went into Citibank had to convert at $32 for these guys to make substantial money. And that's when Citibank was trading at $19. As we're all aware, Citibank went down to $3.50, now trading at $7, having had the US government bail them out. So this is not a pretty sight, and I'd suggest as we go through, this is going to lead to a difference of opinion on how sovereign wealth funds are being looked at and how they are looking at investments. So how does it affect the capital markets? Well, we can talk about this all day, but we won't, because it'll bore people to tears. But there are various ways of looking at it. One is looking at the global traded capital markets and looking at the amount of influence the sovereign wealth funds have on the capital flows. And what this page is saying is that if you look on the left-hand side, we've got global, and going across to the right, US and Europe, total traded volume, debt traded volume, and equity traded volume. And the answer is that sovereign wealth funds have a remarkably little interest in the actual traded flows. Most of the money they're putting in is in direct investments, or minority investments, or created transactions. Having said that, and getting to Brendan's comments earlier, they are getting into CDOs and CDSs, they are getting into derivatives, and they are losing a lot of money in doing it. Actually, we're going to skip through a few pages here. This is an interesting page in that when people get upset about sovereign wealth funds, they're usually getting upset for two main reasons. One is that national security could be compromised, and the sovereign wealth funds are investing in, if you like, national icons that should be really to the betterment of the local country, and that they're being subsidised. In other words, the investment's going in at non-commercial rates, because they're trying to buy influence and buy strategic investment without paying the right price for it. And in the work we've done, we believe that that is actually a very small phenomenon. Only 5% of direct investment, we believe, is going into international sensitive assets at less than market rates. So our view, and I'll preempt our view, and it's in the report that's been written, but our view is that the concern of the sovereign wealth funds is overblown, and figures like this confirm that. Another way of looking at the influence sovereign wealth funds has on the global capital markets is this slide, and I'll go through this very quickly because we can spend a long time on it. There are 5 main areas of the capital markets that could be influenced by sovereign wealth funds. The global capital markets, which we've talked about a bit already, the financial intermediaries, asset managers, other financial institutions like the investment banks and the hedge funds, if you like, companies that have sovereign wealth funds as an investor, and the professional service firms like the accountants and the lawyers. With regard to the global capital markets, areas of risk and concern surround asset prices, maybe asset bubbles, if they decide they're going to invest in certain classes of assets, hedge fund risk, derivative exposure and credit exposure, and asset allocation. So there are a whole range of areas that could be affected. To date, I don't believe they've been very instrumental in affecting that. With regard to asset managers, even though they are becoming more direct in their investments, their asset management is going up. There is business to be won there. In terms of the financial intermediaries and the other investment banks, particularly the hedge funds, And partly the reason why Lehman going down was such an issue was because of the counterparty risk for all the CDSs and CDOs they wrote. And just as a matter of disclosure, I used to work at Lehman for 8 years in London and New York, and personally, I think it was a travesty that went down. But for the hedge funds, liquidity, counterparty risk, new investors and clients, understanding those are an issue. So, what do people think? This is again an interesting slide. This is a slide that was produced in January of this year. And I put this up on purpose because we're going to get to a slide that I put together as of 2 weeks ago. But as of January this year, there are polarised views. Okay, so at the top of the page we have what I call the considered views. Steve Schwarzman, old friend of mine, and Warren Buffett. And Schwarzman, ex-Lehman guy, now the head of Blackstone. Sovereign wealth funds are smart, long-term, highly professional, and all they're looking for is the highest returns with safety. In that sense, they are model investors. Warren Buffett, reasonably successful investor. This is our doing. Now, this is in response to the investment directly into large US institutions, not just the financial ones, but also oil, ports, telcos. This is our doing, not some nefarious plot by foreign governments. Our trade equation guarantees massive foreign investment in the US. When we force feed $2 billion US daily into the rest of the world, they must invest it somewhere, and somewhere here, and he's quite right. Going down the page, we get to Nicolas Sarkozy, who comes out with a very considered, sophisticated French view, which was, we will not be sold down the river to funds that do not meet the transparency criteria one is entitled to expect in a civilised world. Only the French can be civilised. And again, from an American, well-known American, Ed Truman Peterson, governments will mismanage their international investments. This is referring to his view on the foreign governments that own sovereign wealth funds that are making investments. Governments will mismanage their international investments to their own economic and financial detriment, and with negative consequences to global economic and financial systems. So, lots of differences of views, and again it was borne out by people perceived the lack of transparency, political issues, subsidised investments, unregulated investment, and frankly a lack of understanding. On this page here, we've attempted to just really corral the views, and on the vertical axis we've got importance of sovereign wealth funds to the capital markets, and if you look at the bottom, I'd take that as positive, part of the changing landscape, not bad. At the top, negative, sovereign wealth funds are problematic. So bottom, so on the horizontal axis we've got, well, what sort of extra regulation do we need for sovereign wealth funds? Martin Wolf, very respected Financial Times journalist, I'd probably be where he is. But as you can see, there's a plethora of views. With Larry Summers, who's just now been put in the next US president's cabinet for finance, probably somewhere less happy than Martin Wolf. Again, if I'm going through this too quickly or you'd like to ask questions, please feel free. Okay, we'll go through that a bit. So why are there different views? And I think for me the answer is very simple. And the reason there are different views and quite heated different views is because everybody comes from a slightly different angle. At the top we have policymakers, governments. In our case, it was a bank, say, capital market regulators, say ASIC, APRA, foreign direct investment regulators, say our FIRB. Then you get to the investment banks and the participants, companies that have sovereign wealth funds as a shareholder, and then the governments of the sovereign wealth funds themselves. They all have a different perspective, from a time perspective to a we need the capital perspective to a political perspective. So it doesn't surprise me that there are a real divergence of views. I'm going to skip through a couple of pages. So what are the concerns? How can they be explained? So on this page we're going to go through what the concerns could be. On the next page we're going to go through what the answers could be. The themes and concerns are unintentional distortions of the capital markets and systemic risk. Large amounts of unregulated capital and limited disclosure could disrupt price setting mechanisms and increase volatility. Intentional influencing and destabilising of investee nations. This is the political game. Access to strategic interests and information. This is, if you're going to invest in our defence company, you're going to get defence secrets. And the subsidisation of investment, i.e. you're making it too cheaply to buy your way into influence. You could add to that reciprocity. In other words, you can invest in our country, we can't invest in your country. And that pretty much covers what they're talking about. Here are the answers to that from our perspective. And as you may expect, given my earlier comment, we're not too fussed. We feel that there is, and if you remember back to the previous slides, where the, if you like, the influence was not that great, we don't see the risk of the capital market distortions being great. It's still, even though large and growing, relatively small. In terms of destabilising and influencing the political game, that's a political issue. It can be solved through, if you like, political solutions. Access to strategic interests and information. Again, every country has their limits on that. For example, in Australia, we have foreign limits on the banking sector, on the telco sector, and on the defence sector. So in terms of getting access, that's limited. And in terms of subsidisation and sub-investment quality, investment valuations, I think you'll find that's changing as we speak, because they've lost so much money going in. So, this is the thing I put together about where we are today. Let me just read a few of these out to you because I think it's quite telling. This is today, the next slide is tomorrow. Built a year ago as saviours of Western capitalism, sovereign wealth funds now look as vulnerable to the credit crunch as anybody else. Now their future is looking less rosy as the value of their investments sink, tumbling oil prices reduce future income, and the governments eye the extra capital to reflate their own local economies. Sovereign wealth funds may have seen paper losses in the order of 25% this year on the global stock markets. World stock markets fell 47% this year, while those in the emerging markets, where many of the sovereign wealth funds are from, endured an even bigger loss of over 60%. I'd suggest if you look at the developed markets in the financial services sector, the losses are probably 60 to 80%. Okay? We acknowledge that sovereign wealth funds' firepower may have been constrained. We are now taking seriously the possibility that some may be forced to slow their pace of purchases of risky assets and may be liquidating. Okay? Outlook and implications. The relative absence of the wealth funds' investment in the financial sector when compared with their first wave of investments late in 2007 to 08 does not mean they have disappeared. They will be back. Personally, I feel they haven't disappeared. They will be back, but they've certainly taken a big hit. And I think the level of influence they've got is probably a little less than people think.
Okay. Thank you very much, ladies and gentlemen. It's been great.